If you look at your latest lease renewal, you probably feel like you are losing your mind. The national headlines claim the rental crisis is over and rent growth is slowing down. Every time you turn on the news, some analyst in a custom suit points to a chart declaring victory over inflation, promising the housing market is finally cooling off. But then you open your renewal notice, and your corporate landlord is demanding another $200 a month. If that disconnect makes you feel insane, listen closely. You are not crazy, and you are not bad at math. When mega property management companies say the market is cooling, they are speaking the language of their shareholders, not your checking account. Slower growth does not mean cheaper rent. It just means rent is increasing slightly less aggressively than last year. Think of a car speeding toward a brick wall at 100 miles per hour. If the driver eases off the gas to 80 miles per hour, the acceleration is technically cooling, but you are still crashing. Rents remain permanently elevated. You are not failing at budgeting. You are not spending too much money on iced coffee or streaming subscriptions. You are currently caught in a mathematical trap designed by multi-billion-dollar corporations. Today, we are exposing exactly how a hidden, tech-driven algorithm is artificially dictating your rent, how Wall Street has quietly redefined what a lease even is, and why the math of the modern housing market in 2026 has been rigged against you from the very start. To understand how this trap works, and more importantly, how to actually escape it, we have to look at the golden rule of personal finance. It is a rule you have heard since you were a kid. Never spend more than 30% of your income on rent. Financial advisors preach this like it is an unbreakable law of gravity. They promise that if you strictly follow it, everything else in your financial life will magically balance out. But where did this magical 30% rule actually come from? Did modern economists calculate the perfect modern budget? No. It was invented in 1981 as a highly specific government formula to cap rent exclusively for low-income public housing tenants. It was completely arbitrary. It was never meant for the middle class. Yet somehow, through decades of lazy financial advice, it escaped into the wild to become the universal benchmark for every renter in America. Let us talk about 1981 for a second. Back then, people actually had company pensions. College tuition could be paid off with a part-time summer job. The average American was not carrying crushing lifelong student loan debt. You did not have to pay for a mandatory high-speed internet connection just to apply for a job. The fundamental cost of existing in society was entirely different. Trying to use an arbitrary 1981 public housing formula to budget for a modern apartment in 2026 is mathematically guaranteed to wreck your budget. To truly understand why this outdated formula destroys your bank account today, let us look at a renter making $48,000 a year. On paper, their gross income is exactly $4,000 a month. They find an average one-bedroom apartment running $1,200 a month. $1,200 is exactly 30% of $4,000. The property manager runs the credit check and approves it. The system says this renter can easily afford it. But here is the brutal reality. After federal and state taxes, health insurance premiums, and basic retirement contributions, this renter does not take home $4,000. They actually take home just $3,200. That $1,200 rent payment is no longer 30% of their money. It is now pushing 40% of their actual usable money. And that's before they've bought a single grocery or turned on the electricity. That sounds complicated, but simply put, it means landlords are judging your ability to survive based on phantom money you never actually see. They qualify you based on your gross income, but you have to live your actual life on your net income. You cannot pay your landlord in percentages. You pay in dollars. The entire leasing industry forces millions of Americans to sign leases they mathematically cannot afford on day one. Now you might be thinking, at least the actual price of the apartment is determined by the free market, right? Supply and demand. If a building has empty units, the landlord has to lower the price. Wrong. Landlords are not guessing what you can afford anymore. Supply and demand has been completely neutralized. They use that outdated 30% gross income figure to feed a massive digital algorithm.
Welcome to the algorithmic pricing trap. Over the last few years, software companies created products that completely destroyed the free rental market. To understand how insidious this is, imagine if every single gas station in your town stopped competing. Instead, every gas station owner handed over their private pricing data to one central boss sitting in a skyscraper, and that central boss told every single gas station to charge exactly $5 a gallon. If human beings did that in a back room, you would call it illegal price fixing. The government would throw them in federal prison for running a cartel. But when multi-billion-dollar tech companies do the exact same thing with your apartment building using a computer program, they proudly call it revenue management. That sounds complicated, but simply put, it means corporate landlords have essentially formed a legal cartel through software. The algorithm collects private, daily pricing data from thousands of landlords. It knows exactly when your lease is up and exactly how many units are empty in your zip code. It uses that data to spit out a daily, non-negotiable price for your specific apartment. In the past, human landlords were terrified of empty apartments because they lost money every single day, but the algorithm literally tells landlords it is more profitable to let an apartment sit empty for 3 months than to lower the price for a struggling family. By artificially keeping the rent incredibly high on the empty unit, it justifies raising the rent on everyone else already trapped inside the building. And the absolute worst part is, the algorithm removes all human empathy from the equation. When you beg for a break on your rent increase, you are no longer negotiating with a landlord. You are talking to a leasing agent who acts as a human shield for a computer program. They point to their monitor, shrug, and say they do not have authorization to override it. You are arguing with a wall of code. But the algorithmic base rent is only the first part of the trap. The second part is the illusion of the menu price. Once you sit down to sign the lease, you are hit with a barrage of mandatory junk fees. This is the budget airline model applied to human shelter. They lure you in with a base price online that looks affordable, but the moment the ink is dry, the fee stacking begins.
There is the mandatory technology fee for a digital door lock that stops working every time it rains. There is the convenience fee, charging you $30 just for the privilege of paying your rent through their mandatory online portal. Then there is the absolute scam of the trash valet fee, forcing you to pay someone $50 a month to carry a garbage bag 30 feet down the hallway, and half the time they do not even show up. Add in the mandatory package locker fee, and do not forget pet rent. You already paid a massive non-refundable deposit, but they still charge you $60 a month. Your golden retriever does not have a corporate job, and he is certainly not using the community fitness center, but you are paying a monthly subscription for him anyway. Through all these mandatory microcharges, corporate landlords have invented a shadow rent. This shadow rent never shows up on the initial listing. It is not factored into that outdated 30% rule your financial advisor told you to follow, but it drains your checking account every single month. A $1,200 apartment instantly becomes a $1,400 apartment before you even turn the key. This fee stacking feeds directly into the most ruthless part of the system, the renewal trap. When your 12-month lease is up, the software knows you work 40 hours a week. It knows you do not have the physical or mental energy to pack dozens of boxes on your only 2 days off. It knows coming up with a new security deposit for a different building is financially and emotionally devastating, so it charges you an exhaustion tax. The algorithm calculates the exact mathematical pain point of moving. If escaping to a new apartment would cost you exactly $1,200 in moving expenses and lost time, the algorithm will automatically raise your yearly rent by $1,199. They price your rent hike exactly $1 below the absolute cost of escaping. You are trapped in a space you can barely afford, paying junk fees for amenities you do not use, completely at the mercy of a computer program that knows you have nowhere else to go. Whenever you complain about this broken system, some older relative always hits you with the exact same tired advice. They tell you renting is just throwing money away and you should just buy a house to build equity. That is a fantastic idea, except for one massive, glaring problem.
In 2026, buying a house is mathematically out of reach for the average renter.
Because of elevated interest rates, constrained supply, and Wall Street hedge funds buying up entire neighborhoods in cash, the math of homeownership is completely broken too. Nationally, buying a home currently costs an astonishing 38% more per month than renting the exact same property. You are not building wealth automatically anymore. You are drowning in carrying costs like property taxes and skyrocketing insurance. And here's the dirty little secret your financial advisor leaves out. Thanks to a standard 30-year mortgage schedule, for the first decade of homeownership, almost none of your monthly payment goes toward the actual house. Most of it goes to paying off the massive front-loaded interest from the bank. That sounds complicated, but simply put, it means for the first 10 years of owning a home, you are not actually a homeowner. You are mostly just renting the money from the bank. So let us summarize the brutal reality of 2026. The 30% rule is completely dead. Corporate cartels and digital algorithms are artificially rigging rental prices. Junk fees are massively inflating your monthly shadow rent. And buying a house is a mathematical fantasy for the modern working class. How do you survive when the math is broken? You have to fight the algorithm with leverage. First, you must weaponize data. Do not ever accept the first lease renewal number they slide under your door. Treat that piece of paper as a highly aggressive opening bid. The algorithm relies entirely on your passive obedience. You need to use independent tools to pull exact, localized rent comparables in your zip code. Look at what your own building is actively offering to brand new tenants online. Print out those new tenant concessions, walk into the leasing office, and demand the exact same deal or threaten to walk. Force them to do the math on losing you. Second, manipulate your lease terms to break their seasonal math. The algorithm desperately wants your lease to expire in the summer because that is the peak moving season when they can charge maximum rent. Do not let them control the timeline. Aggressively counteroffer with a weird, non-standard lease length like 13 or 15 months. Your goal is to force your next lease expiration directly into the winter dead zone. The algorithm is absolutely terrified of winter vacancies. Often, the software will drop the monthly rate automatically for a 15-month lease just to avoid cold weather turnover. Use their own programming against them. Third, audit your shadow rent and hunt down the humans. Sit down with a highlighter and identify every single junk fee attached to your ledger. If you are paying for trash valet or package delivery fees that you never use, formally demand to opt out. And when your lease is finally up, actively look for independent mom-and-pop landlords who do not use algorithmic pricing software. Private landlords just want a quiet, reliable tenant who pays on time. They are not trying to maximize shareholder value by squeezing an extra $40 out of you for a pet fee. If you are permanently stuck in a massive corporate building, you have to talk to your neighbors. Corporate landlords thrive on your isolation. They want you suffering in silence. But when 20 different tenants walk into a management office at the exact same time to dispute an absurd garbage fee, the human employees panic and the algorithm breaks. There is immense power in collective tenant action. A corporation can easily ignore one angry email, but they cannot ignore 30 residents standing in their lobby. You are not crazy. You are not terrible at managing your money. You are facing off against highly tuned tech monopolies designed to extract every single dollar from your pocket. The financial math has been lying to you for decades. The experts on television telling you to just budget better are completely disconnected from the brutal reality of the modern rental market. Stop feeling guilty about your bank account. Stop listening to outdated financial rules created in 1981 for an economy that no longer exists. Start using your leverage, your data, and your voice to fight back against the machine. The system wants you exhausted, it wants you isolated, and it wants you paying shadow rent until the day you die. Refuse to play their game. Take back your leverage, control your timeline, and demand your worth. Because in the modern housing market, no one is coming to save you, and your financial future literally depends on it.